Imagine paying a massive 27% premium just to get your hands on a single barrel of oil today.
Right. While simultaneously betting that the market is going to be, perfectly calm tomorrow.
Yeah, it sounds like a complete contradiction. I mean, it makes almost no logical sense on the surface, but if you look at the underlying data, that is exactly what the world's top commodities traders are doing right now.
It really highlights this massive disconnect between, well, the physical reality of supply chains and the psychological expectations of the financial markets.
Welcome to the deep dive. We are going beneath the surface today because we've got our hands on an incredibly detailed piece of source material. It's the May 4, 2026 Commodities Dashboard Report from Citi Research.
And it's a goldmine because when you only look at the top level price of a commodity, you miss that entire hidden narrative.
Exactly. Our mission for this deep dive is to look past those basic daily ticker prices. Like if you're watching the financial news and you see a headline screaming that oil is up 2%, your first instinct might be to just react to that single data point.
Right, which is what most people do.
But this dashboard, it actually reveals the gears turning inside the market. We're going to decode the 4 specific dials the experts at Citi use to read the global commodities engine. And those are curve structure, volatility, momentum, and positioning.
And learning to read those 4 dials together, it fundamentally changes how you process financial news. You stop reacting to random price jumps.
Yeah, you start seeing the underlying architecture, you see what the institutional traders are genuinely worried about, where the hedge funds are placing their literal billions, and critically, which markets are screaming that they're dangerously overextended.
So to understand what's really happening out there, we kind of have to start with the first dial on the dashboard, which is the curve structure.
Right, because before you can understand where the capital is flowing, you really have to understand how the market values the timeline of a physical asset. Time is like the hidden variable in every single commodity trade.
It is. And the curve structure measures exactly that. It tells us the premium or the discount the market places on having a physical commodity in your hands right this second versus having it delivered to you a few months or, a year down the road.
Which brings us to 2 foundational states of a market, backwardation and contango. And I know those sound like dense academic terms.
They do, yeah.
But the mechanics behind them are actually fascinating. Let's start with backwardation. In a normal market, things in the future should cost more because, well, you have to pay to store them.
Exactly. There's a cost of carry.
Right. But in a backwardated market, the timeline flips. You are paying a massive premium for immediate delivery. It means the supply chain is fractured or just completely drained. Like industrial buyers are desperate for the physical material today just to keep their factories running.
And the dashboard shows us some wild extremes on this front, particularly in the petroleum complex. It is historically tight.
How tight are we talking?
Well, looking at the 1-year backwardation levels, WTI crude oil is sitting at a 27% premium for immediate supply.
Wow. And the Citi report actually notes that ranks in the 99th percentile for the last 5 years.
Yeah, it's almost unprecedented. And Brent crude is even tighter at 28%. We're seeing similarly heavy backwardation across the entire energy sector, honestly.
Like RBOB gasoline, right? I saw that was at 30%.
30%, gas oil is at 38%, and heating oil is at 29%.
That is just wild. This isn't just some slight preference for immediate delivery. This is a market acting like a frantic buyer who's willing to pay whatever it takes to secure physical barrels today.
Right, and the core driver behind that 99th percentile backwardation is a prolonged period of structural tightness. We aren't just dealing with a brief logistical hiccup here.
It's deeper than that.
Much deeper. We're looking at a market where producers, specifically OPEC and its allies, have actively managed and constrained physical supply. They've drawn global inventories down to the absolute bone.
So when storage tanks at major hubs are running near operational minimums, the refiners start to panic.
Exactly. They need crude to make gasoline today, not 6 months from now. So they bid at the spot price, which drives that massive 27% backwardation.
It's basically the cost of immediate security. And the report also highlights aluminum, soy oil, and coffee as being heavily backwardated too, pointing to similar immediate supply deficits.
But, the curve dial swings both ways.
It does, which brings us to contango. That's the opposite scenario, right?
Yeah, contango means there is plenty of physical supply around today, and the market is essentially charging you for the burden of holding onto it.
A great way to visualize contango is looking at what commodities traders do when the future price is significantly higher than today's price. Like a trader will literally charter an enormous oil supertanker, fill it to the brim with crude, and just leave it parked offshore in the ocean for 6 or 12 months.
Because the future payout is so much higher.
Exactly. It covers the daily multi-thousand-dollar rental fee of the ship, the insurance, the financing, all of it.
Right, so when a market is in contango, it's effectively paying you to act as a storage facility. And looking at the dashboard, we see copper sitting at negative 5% backwardation, which means it's in a 5% contango.
And sugar is at negative 7%.
Yeah, and corn is way down at negative 11%.
Those negative numbers for corn and sugar, that points to massive current stockpiles. The grain elevators are just full. The physical reality of those markets right now is comfortable abundance.
So we've established the physical supply reality today, right? Oil is historically tight and corn is comfortably abundant. The logical next step is to examine how nervous traders are about tomorrow.
Which transitions us perfectly to the second key data point, the second dial on the dashboard, volatility. We are moving from the physical reality of the curve structure to the psychological state of the market.
Right, which is measured by the volatility premium. And this is a simple but really powerful metric. It measures the difference between realized volatility and implied volatility.
Realized volatility is just looking in the rearview mirror, right? It tracks the actual mathematical price swings a commodity has experienced over the past month.
Exactly. And implied volatility is looking through the windshield. It represents what the options market The traders who are buying financial insurance against price crashes or explosive rallies, thinks will happen over the next 3 months.
So when implied volatility is higher than realized volatility, you have a positive volatility premium. It tells you traders are bracing for the market to get significantly more chaotic than it has been recently.
And this is where the data presents a fascinating puzzle.
It really is. I look at these numbers and I immediately see a glaring contradiction. I mean, we just established that the energy market is operating with a 99th percentile backwardation. The physical market is literally screaming for immediate supply.
Right.
Logically, shouldn't energy traders be the most panicked? Shouldn't they be paying the absolute highest volatility premium to protect themselves against a sudden supply shock that sends prices into the stratosphere?
You would think so, but the data tells the exact opposite story. The energy sector actually has a strongly negative volatility premium right now.
Wait, negative?
Yeah, the WTI crude is at negative 47%, and Brent is at negative 52%. Even precious metals like gold and silver are showing negative volatility premium.
A negative 52% premium means the options market expects the future to be significantly calmer than the past. How does a market that is starving for immediate supply simultaneously believe there's zero risk of a chaotic price explosion?
The answer lies in the difference between a tight market and a panic market. I mean, oil is incredibly tight today, but it is a known tightness. The market understands exactly why inventories are low.
Because they see OPEC's production schedules.
Exactly. They know exactly what the global refining capacity is, and they've priced all of those known constraints into that 27% backwardation.
So traders aren't willing to overpay for options insurance because they don't foresee an unknown tail risk shock over the next 3 months.
Right, the engine is running hot, but the mechanics know exactly why it's running hot, and they don't expect it to blow a gasket.
They've priced in the reality, so the psychological fear just isn't there. But if we look down the dashboard to see where the psychological fear actually lives, it's entirely concentrated in the agricultural sector and industrial metals.
The contrast is striking, isn't it? Corn has a positive 14% volatility premium. Soybeans are at positive 7%. Wheat and copper are both sitting at positive 6%.
And we just noted that corn is in an 11% contango. The silos are completely full today, yet agricultural traders are paying massive premiums for options insurance over the next 3 months.
They have physical abundance, but overwhelming psychological fear.
What's driving that?
Well, the Citi report provides the underlying mechanism for that fear in a separate macro note. They highlight a, quote, strong El Nino leading to regional yield divergence across ICE softs and CBOT grains.
It always comes down to the weather for the ag markets, doesn't it?
Always. Weather introduces an element of chaos that you simply cannot model with the same precision as an oil refinery's output. You might have plenty of corn in the silos today, but the options market is staring down the barrel of a massive, unpredictable climate event.
Because El Nino creates intense regional disruptions, like floods in one hemisphere, devastating droughts in another. You can't perfectly predict where the damage will hit or how severe it'll be.
Exactly. Therefore, agricultural traders are heavily buying options to protect themselves against wild, unexpected swings in upcoming crop yields. They are bracing for an impact they just can't entirely quantify.
That distinction between the physical supply today and the psychological fear of tomorrow is crucial, but, fear and supply only matter if institutional players actually put their capital on the line.
Right, which brings us to the final two dials on the dashboard, where we look at the actual cash flows, momentum, and position.
We are moving from the theoretical pricing of options and supply curves to the cold, hard reality of where trader cash is currently deployed. Let's tackle momentum first. The dashboard tracks technical indicators, specifically the MACD diff.
Yeah, for those who might not trade off technicals every day, MACD stands for Moving Average Convergence Divergence.
Right. In simple terms, it measures the distance between a short-term price trend and a long-term price trend. When the MACD diff is high, it means the current price is accelerating violently away from its historical average.
It basically measures the sheer speed and momentum of a market move. And the most dramatic signal on the entire Citi dashboard right now belongs to nickel.
Nickel? Really?
Oh, yeah.
Yeah.
It is flashing a massive momentum and overbought signal, with a MACD diff of 124.4.
Wow. And to put a number like 124.4 into perspective, the report notes it places nickel in the 92nd percentile historically over the last 2 years. The speed at which buyers have rushed into nickel is extreme.
The mechanics behind a momentum spike like that usually involve a squeeze in the physical market cascading into the financial derivatives.
Like supply chain bottlenecks.
Yeah, export quotas or smelting issues in major producers like Indonesia, combining with surging industrial demand for electric vehicle batteries. When industrial buyers scramble to secure supply, the price accelerates.
And then algorithmic trend followers see that acceleration and start buying the financial contracts, which forces the price up even faster.
Exactly, becomes this self-fulfilling momentum loop, which leads directly into our final dial, positioning. The Citi dashboard uses commitment of traders, or COT data, specifically tracking managed money.
And that term essentially means hedge funds, commodity trading advisors, and large algorithmic speculators, right?
Right. Positioning tells us how crowded a trade has become. Yeah. It measures the aggregate size of the bets these massive speculative funds have placed on the market.
You can almost think of it like observing the balance of a massive cargo ship. Like if you have shipping containers distributed evenly across the deck, the ship is stable, it can weather a storm. But if the crew moves 90% of those heavy containers to the far right side of the deck, the ship becomes dangerously unbalanced. A single unexpected wave could capsize the whole vessel.
That's a great way to look at it. And looking at the COT data, the global commodity ship is heavily tilted right now. The speculators have massively piled into long positions, meaning they're betting the price will go up, in Brent crude, platinum, aluminum, nickel, live cattle, and the CBOT grains complex.
And on the flip side, they've completely abandoned the other side of the deck. Speculators show historically weak positioning in Henry Hub natural gas, gold, lead, sugar, and cocoa. They've essentially sold out of those markets.
Right. And when we combine the momentum dial and the positioning dial, we expose what financial analysts call the core risk of the current market environment.
I look at the historical ranks for these positions, and the numbers are just staggering. Brent crude and nickel are sitting in the 89th and 90th percentiles for speculative positioning.
It's crowded.
Extremely. That means 90% of the time over the last few years, hedge funds held fewer long positions in those markets than they do right this very second.
Which brings up the critical vulnerability. If every single hedge fund and algorithmic trader who wants to buy oil or nickel has already bought it, who is left to supply the fresh capital needed to keep driving the price up?
The trade is completely exhausted. There is literally no marginal buyer left.
Exactly. When a market becomes universally loved and the positioning hits the 90th percentile, it becomes highly vulnerable to a sudden, violent unwind. At that point, the underlying fundamentals, like that 27% backwardation we talked about earlier, almost cease to matter.
Because if a piece of bad macroeconomic news hits, say, I don't know, a surprise interest rate hike or a sudden drop in global manufacturing data, a few of those hedge funds are going to decide to take their profits and sell their nickel or oil positions.
But because the trade is so crowded, there is no one on the other side willing to buy what they are selling. The lack of buyers causes the price to drop sharply. That sharp drop triggers the stop-loss algorithms of other hedge funds, forcing them to sell automatically.
And it just cascades.
Yep. The funds that bought in last start bleeding money, triggering margin calls, which forces even more frantic selling.
The heavy shipping containers all slide off the deck at once. The market capsizes.
It is a textbook overbought scenario. The momentum dial showing 92nd percentile speed, combined with the positioning dial showing 90th percentile crowding, those are blaring warning sirens that the institutional herd is entirely on one side of the boat.
Wow. Let's zoom out and synthesize these four dials for a second. The Citi Commodities dashboard is painting a very specific, highly pressurized picture of the global markets right now.
The narrative it reveals is incredibly nuanced, honestly.
We have an energy market that is suffering from intense physical tightness today, as shown by the extreme backwardation. Yet the options market is strangely complacent, completely lacking a volatility premium because they believe the tightness is fully managed and understood.
Right. Meanwhile, the agricultural market is the exact mirror image. The physical silos are full today, pushing the curve into contango. But options traders are paying massive premiums because they are terrified of the weather chaos El Nino will unleash tomorrow.
And underpinning both of those realities is the flow of speculative capital. The managed money has stampeded into a heavily crowded herd, maxing out their long positions in markets like nickel and oil, pushing momentum into the 92nd percentile, and positioning into the 90th.
This is exactly why you can't just trade off a daily news headline. If you just read an article stating that nickel prices surged on battery demand, your instinct might be to buy in.
Yeah, FOMO kicks in.
Exactly. But by looking at curve, volatility, momentum, and positioning together, you see that the trade is already universally crowded. The easy money was made months ago, and the current risk of a violent unwind far outweighs the potential reward. You stop reacting to the speedometer and start reading the engine's internal pressures.
That holistic view is the definition of being well-informed. It allows you to anticipate capital flows rather than just blindly chasing them, which leaves us with a final provocative scenario to ponder.
Okay, let's hear it.
We have speculative billions deeply entrenched in the energy and industrial metals markets, confident that the known supply tightness will hold. Simultaneously, the options market is pricing massive, unquantifiable uncertainty into the agricultural sector. What happens to this delicate balance when a totally unexpected macroeconomic shock hits the global system?
Like a sudden liquidity crisis, or an unforeseen geopolitical conflict, or even a major currency devaluation.
Exactly. If the system gets jolted, do those deeply crowded oil and nickel trades violently unwind as every hedge fund rushes for the same narrow exit door to cover their losses? Or do those highly volatile, weather-threatened agricultural markets suddenly explode to the upside because the options traders were absolutely right to be terrified?
It is a hidden tension in the global markets that you can only see if you know how to read the underlying dials. The mechanics of the market are certainly wound tight in very specific sectors right now.
We will definitely keep our eyes on this dashboard to see which of those scenarios plays out first. Thank you so much for joining us on this deep dive into the hidden architecture of the commodities market. Be sure to subscribe to the channel because I promise you the next time we pull apart the financial sources, it is going to be even more exciting.
Please note, this audio is for research and analysis purposes only and does not constitute any investment advice.
Catch you next time.